The prices of Bitcoin, gold, and silver have been moving dramatically in the last few weeks. What's next? That's the question all investors are wondering, and we'll be dissecting market movements with our next two guests. They are technical analysts who work together at Northstar Badcharts, Kevin Wadsworth and Patrick Karim. Welcome back to the show. First time I've had both of you on together. I've spoken with you individually. What a treat to have both legends in the same space together. Welcome back.
Thanks, David.
So nice, David. So nice.
I'm not being nice. You're the ones with thousands, tens of thousands of followers on Twitter and social media. A lot of people follow your work and they appreciate what you do. So welcome back to the show. Let's start with Bitcoin. Big moves this week. Today especially, it's down 5% as we speak on Monday afternoon. We're touching the 32,000 mark, 32,000 US. So let's start with Kevin. I know you and I have spoken about Bitcoin before, and you've used arc patterns to predict price movements for Bitcoin. So can you just give a rundown of what happened in the last, I guess, few weeks to months, and then?
Yeah, well, since we last spoke, Dave, you might remember that I mentioned in the interview that I felt that the crypto market in Bitcoin was likely to peak in October of last year. I also talked about the possibility of some higher prices. The prices at the time, I think we were talking, were in the mid 40,000s of US dollars, and we've moved up, of course, to around about 69,000 US dollars. It peaked just about the time that I thought it would, and of course has been declining ever since. And I think the really key point that investors really have to take on board here is that however bullish you want to be on the cryptos and however much hope you might have, we're below the key declining moving averages now. So the 200-day moving average for Bitcoin, the 30-week moving average for Bitcoin, I tend to use that as a guide, and we're below those key moving averages now. We've broken below some very key support. 30,000 is almost here now, and that's critical to whether we get down to the next drop at 20,000.
Okay, I want to come back to your forecast, Kevin, but Patrick, why don't you jump in here and tell us maybe what happened, in your opinion, over the last few months? Like Kevin said, the price peaked around October, November. Why do we see this big decline?
Well, I've done a chart because it's a big debate, right? Is Bitcoin a commodity? Is it gold? But as a chart trader, what I'm trying to see is I want to see exactly what type of asset it is or what it behaves like, to give us a sense of what category to fit that in. And the issue with Bitcoin is we had no data prior to 2011, right? It was born at the exact same time that we started a new bull era in tech stocks, 2011. So it's kind of tricky. So for now, what I did, I had a chart where I measured the NASDAQ divided by gold. So how many ounces of gold does it cost to buy a NASDAQ share? But I did the same exercise with Bitcoin, how many ounces of gold it costs to buy Bitcoin. When you overlay those two ratios together, David, they track practically the same since 2011. So as soon, whatever micro drivers we have right now that are removing capital flows from US equities, and we have a gold chart versus the SPX to show that those tidal waves of an inflationary cycle, they're starting to leave U.S. equities to go into value assets like gold, commodities, et cetera. The same capital flows are now affecting Bitcoin. So unless Bitcoin proves to us that, no, look, I like inflation and I will diverge from U.S. equities topping and moving down. Like Kevin said, right now they're behaving exactly like the NASDAQ or any other stock. They're having a hard time staying above their important moving averages. So you got to put them in the bucket of tech stocks right now, with those macro drivers, and they're vulnerable.
Just to clarify, so I understand, did you say the ratio of the NASDAQ index to Bitcoin has been the same since 2011, or are you just saying they've been moving the same direction?
The ratio of NASDAQ to gold, I overlay that ratio with the Bitcoin to gold. So instead of measuring them in US dollars, I want to measure them in a common denominator, but something else like gold. And those two ratios, they look the same.
I see. That's very interesting. Okay. Yeah. I'd love to see a chart on that.
Yeah.
Kevin, let's go back to your forecast now. So you were definitely correct. Earlier we spoke last year. You called for a top in the Bitcoin price around November. You had said that it's possible to reach $100,000 by the top. The price wasn't exactly there, quite there yet. What do you think held the price back from reaching your target initially?
Yeah, well, the baton's been handed over well and truly from, as Patrick was saying, general equities, tech stocks, to hard real assets and commodities. And there's been a gradual shift taking place, and I've referred to it as a paradigm shift. it became very, very clear, I think, with the 10-year yields crossing a very key level. Now that chart, I think I've shown quite a few times in many different contexts, and crossing that particular pain line is what I refer to it as, has brought on a lot of pain in the markets and a lot of vulnerability. And I think this is what's sort of taking place now, and we're seeing a steady rotation. Bitcoin just ran out of steam, ran out of impetus when it made that sort of marginal new high, just slightly above the previous high that was achieved in earlier on in 2021. There, it wasn't at all convincing, and it didn't break any higher. And the key to it was when we broke below those key moving averages. There was always a hope that the cryptos will continue. And in fact, it's only just very recently the crypto total market cap and the altcoin index have broken down, and they're probably even more important than the Bitcoin charts. So the crypto total market cap is now breaking down. It's somewhere in the region, I think, of around about 2.8 trillion, something like that. In fact, I'll just double check my chart here. I was wrong about that. It's 1.47 trillion.
Mm-hmm.
So the crypto total market cap is breaking down, which is very, very important, because there's not a lot of support on the chart, I have to say. We're resting on just about final support now. And if it breaks and gives way, I'm afraid the crypto total market cap could fall by as much as 75%. And you can imagine we're already in a position where some of the altcoins have fallen 90% from their highs.
Wow. Okay. So how much more downside is that, Kevin?
Well, as I say, some of the altcoins have already fallen 90%, and going through them one by one yesterday, it looked to me as though many of them were going to see falls from the peaks, either late last year or early this year, of somewhere between 90 and 99%. Bitcoin may well sort of stop somewhere around about the 80 to 85% mark, and some of the leaders may stay a little bit higher with total losses of between 70 and 85%. But I think many are going to be seeing 90 to 99% losses.
Patrick, do you agree? I've always wondered if you two have differing views. You work together, you publish the same newsletter, but surely you can't agree on everything. But in this case, do you agree with Kevin?
Well, yeah, I mean, Kevin, we often have brainstorms and we try to keep each other in check, right? And I have a slightly different way of viewing stuff than Kevin, but like we try to always be objective. And the Bitcoin, like I think in the February of 2021, it was super stretched from its moving average. It was around 58,000 and was still climbing upwards. But I saw that was historically stretched from its moving average. So I was super, like I thought a lot of people get trapped above 55,000, can't really call the top. But since then, it's moved sideways. And right now, until the chart proves you otherwise, you're below that 200-day moving average. There's huge topping patterns in the NASDAQ, et cetera. You got to let that price action, you have to let it fall. And there's a thing in TA called reverse symmetry moves. So as fast as we went up, David, there weren't a lot of support being built up, right? Because it just went up super high. And now, as soon as you break up from a huge topping pattern, then the fall down is as fast as you went up, right? So you have to let the dust settle, and you have to stay clear. You draw a descending trend line, and then you have to let the price heal, because most of these crashes, as soon as you've corrected over 60, 70, 80%, you need a multiple of time for the price action for those bag holders to really give up. Then you could build a new sustained uptrend. So right now you stay clear, you wait for the dust to settle. And as soon as the moving average starts slowing down its rate of descent and the price action starts going back up, then you have a low risk, high reward opportunity once again.
Price targets, gentlemen, for Bitcoin, and then we'll move on to the precious metals.
I'm going to say 20,000 or less.
Patrick?
Yeah, that reverse symmetry move. So we've looked at that there. If we close there below that 30,000 there, it could be a vacuum, a spike down all the way easily to 20,000 for sure.
Okay, all right. Let's for those people who are long, let's hope that doesn't happen. But for those people who are on the sidelines, that may be good news. We'll see. I don't know if you've seen these memes on the internet. You should always buy on the dip. Well, you buy on the dip and then it dips lower and then you see a sad face. That's what's basically been going on in the markets for a lot of different assets. Gold and silver have held up relatively well despite all the other assets' performance. Let's talk about gold first. So we saw very close $2,000 level. Didn't breach it quite yet. What happened there? Why didn't gold breach above $2,000? It happened earlier in the year, right? Remember that?
Well, it happened. We had a spike, didn't we, when the Russian invasion of Ukraine?
Yes.
And anyone that follows us will know very well that that particular move was predicted by ourselves back in 2019. We were able to come up with that prediction purely through weight of evidence, technical analysis. Obviously had no idea that there was going to be a war breaking out in Europe, but that headline-driven spike to over $2,000 was exactly that. It was a headline-driven spike. It wasn't in itself enough to power gold to new all-time highs. It backed off from that, and very clearly when that happens quite as dramatically as it did, we're starting to build out what's known as a cup and handle pattern. So the cup has been forming since mid to late 2020, and that cup's complete. And now we're building a handle on the side of that cup. So anyone who's familiar with technical analysis will know all about cup and handle patterns. And the current target for that pullback is anywhere between approximately 1800 and 1820. Looking at the charts at the moment. So gold could quite reasonably pull back to that 1800 area without breaking any sort of technical analysis rules, if you like, and continuing the bullish look to the chart. Really, think of it as a case of gold went a long way up from around about $1,700 to $2,000. This pullback is what's needed to sort of build the energy and the momentum for a real assault on that $2,000 or just over $2,000 level. And we need to turn that $2,000 level from being resistance into support. And if that's going to happen, then it's going to take a little bit of an effort.
Patrick, I'm just wondering, so going off of what Kevin said about the support level of $1,800, suppose gold breaches that support level of $1,800, is that a bullish or a bearish signal for you? If something breaks support, do you expect it to go down more, or do you think, oh, it's oversold, time to bounce back up?
Those are the questions that any new person to technical analysis asks themselves, but you got to take a step back. Those are dangerous questions because they'll create fear, they'll create analysis paralysis, right? Or so what you have to do, you take a small step out and you have to look at the macro, the bigger time frame. So let's say I look at the gold to SPX ratio. That has a clear cycle since the 1970s or before. There's historically when gold has been outperforming SPX, like in 1980s, you reached high levels. And then when gold started getting underperforming versus the SPX to like rock bottom levels. So buy the dip, you want to do them when the gold to SPX ratio is historically low and turning up. So I'll have one of my charts where you'll see that historically right now, the gold to SPX ratio, the same as it was in 2018, is the same as it was back in 2005, and it's the same as it was in 1972. And we know that gold has set, those were critical historical lows before huge moves up. So every time that ratio resets, David, you got to see that as fuel resetting, right? The gold to SPX ratio resets, it's rock bottom. If gold is doing higher lows on its chart, that's right. That's a bullish uptrend, right? So indeed, 1800, 1600, because the SPX to gold, the gold to SPX ratio is historically low. Those you have to consider in the weight of evidence. Those are buy the dip opportunities. Of course, it could spike. Let's say there's a liquidity crunch and gold spikes to 1650 intraday. Like you got to take a step back, guys. But on the higher time frames, gold is in an uber bullish configuration, guys. Uber bullish.
Uber bullish. Okay. It sounds like you've got something to say there, Kevin. I'll let you respond to that.
I was just going to say, I was just going to say, don't fall into the trap of thinking that gold and silver are suffering at the moment because interest rates are rising or because the US dollar index is rising.
That was my question, actually. If we take a look at the macro landscape of everything going on, do you think the forces are in gold's favor right now, or do you think there's more headwinds for gold? Is it bullish or bearish right now is basically my question.
Very bullish. Very bullish indeed. If you compare the backdrop now to the backdrop that initiated what happened in the 1970s, there are a lot of similarities there. And talking about what we may begin to see unfolding here with a struggling economy and persistent high inflation. So from being a disinflationary environment where inflation is present but falling, to an inflationary environment where, generally speaking, inflation is present but rising. those are very much, very strong drivers for the precious metals. There's a time to be invested in stocks and shares, and there's a time to be invested in precious metals. You can see that very clearly when you look at the charts, the sort of periods of 10 years or more, where the SPX goes absolutely nowhere and gold goes up by hundreds of percent. And I suspect that's a period that we're entering now, where the SPX over the next several years and general equities just tend to suffer large pullbacks and never recover fully before falling further and drift. And during that process, people start to appreciate the advantages of the safe haven asset that gold has always been during these times, and that's what drives a precious metals bull market. There are a lot of factors driving this, and it's not the US dollar index. If you actually inflation adjust the US dollar index, it's falling like a rock and going from the top left to the bottom right of the chart. So looking at the US dollar index in isolation is very much misleading, because all of the components of the US dollar index, the euro, the pound, the yen, they're all fluctuating against each other, but as a whole, they're all going down the toilet compared to hard assets like gold. So, you've got to choose carefully what you compare your apples with, and you need to make sure you.
Well, actually, both of you were bullish on the precious metals when I spoke to you individually last. Was it? I'm just wondering, was it because you foresaw this crash in risk assets that we're seeing now? Let's revisit your rationale. Patrick, I'll start with you.
Yeah. So we have to see this as the transition period from U.S. equities growth to value, right? And yes, my imagination is always faster than the actual markets. And these transitions, 1 year, 2 year, 3 year, you'll see these bottoming patterns in the ratio charts, gold versus the SPX, which ironically, or not ironically, but the gold to SPX ratio, David, it looks exactly like the silver chart. So the capital flows, once they leave US equities and they go into gold, that fuels, it's financialized. Silver is like a precious metal that's financialized. You're going to see that in the movement of silver. So we saw these things in June of 2019, when gold broke out, that huge base, something special was happening. But we were so early. We saw that. We even saw gold breaking out in Canadian dollars, Australian dollars, before it broke out in US dollars. And we're like, Jesus, we're at the turning point of something super important. And right now, what we're living is, if we do an interview in 6 months, 3 months, it's down, gold's up. But what's happening is higher lows. It's all been higher lows, 1150, 1350, 1550. Where are we? Even if we turn at 1850, it's an uptrend. So you got to stay bullish until you start like really closing much, much lower.
Okay. Let's move on to silver, and then I'll get your price outlooks before we wrap up. Silver tends to follow gold. Is it still behaving in the same pattern, you think?
Yeah.
So basically, my question is, if you're uber bullish on gold, you should be uber bullish on silver, would you not?
Silver is a volatile commodity, and I don't suppose you need me to tell you that. And silver has these periods in time where it decides to really spike very, very rapidly. And those are, the exciting times that everybody remembers. But what you need to do, Patrick said before, is zoom out a little bit. And when you hear people saying, "Oh, silver's going nowhere, silver's terrible, silver's not done anything for years." Well, if you tune out of the noise and just plot the 3-year or the 5-year moving average, silver is going up and up and up and up. When you follow the long-term moving averages, cut out the $50 peaks, and you've just got a line that's gradually moving from the bottom left to the top right of the chart, just like gold. And it's because everything around us, whether it's silver, gold, whether it's another commodity, whether it's something that you buy in the shops, whatever it is, there, if you plot the price, it's going from the bottom left to the top right of the chart, because the paper currency that we buy it in is declining, with inflation. So, looking at silver in isolation at these $50 sort of price spikes and saying, well, it's less than it was back in the 1970s is quite misleading, because the moving average is much, much higher than it was in the 1970s. So we've been going sideways for quite a long time now, since around about the middle of last year. We had a very strong run, of course, from March of 2020, when we had the COVID spike down, and the price of silver went very sort of rapidly up towards $30. and it's been meandering around between sort of $22 and $28 for all that time now, and it's built out a very long sideways channel, which until it breaks, and I've said this over and over and over again, until it breaks above that $28 area, there's nothing sort of exciting to report on silver. The downside support technically actually is quite a bit lower than where we are at the moment, so the price could fall down below $21, even below $20 without sort of violating any sort of technical chart patterns. But the key point to remember here is that anything below $21, $22, anything in this sort of area is real value for silver. And looking at the ratio charts, they're all primed to see silver and gold move up very strongly against, for example, Bitcoin and the SPX. So, I'm viewing this entire period as a great opportunity to position for what I'm absolutely sure is going to be a very, very sort of breathtaking move to the upside when it comes.
Patrick, let me just simplify this question for you. When can we see $50 silver?
Look, there's what's happening right now. The markets are really trying to turn a corner. There's high volatility. Gold and silver are precious metals that are financialized. So the gold-silver ratio actually tracks the DXY, it tracks the VIX. So as the US equity is getting liquidated, the US dollar goes up, the VIX goes up, and the gold-silver ratio, since it's financialized, will actually go up. That means silver is going to get sold heavily and gold slightly less extent. Once we're past that, once the gold-silver ratio, right now it's since March Madness, it dropped down. It did a nice bearish rising wedge. As soon as it breaks down from that rising wedge, then we could enact the countdown and answer that question. So when the gold-silver ratio starts unwinding, that means silver is outperforming gold. And silver, when that bearish rising wedge breaks down, silver is probably going to be close to $26, $27. And once we get that close above that, then it will be within 6 months. I'm pretty sure we're going to be above all-time highs once we close above that $28 and that gold-silver ratio breaks down. But we got to get rid of that market fear, that liquidity, whatever the market thinks the markets are going to crash, a liquidity event. Once the markets price that out, then silver is going to be able to freely lift upwards.
Okay, so let's give our medium-term outlook for the price then for both gold and silver. Patrick, why don't we start with you?
Well, for right now, it's going to be sideways, slightly down until this volatility resides. So upside is going to be probably subdued until something happens with the year, the yields, or like some type of guidance macro-wise. It's probably going to go sideways and slightly down to those more important supports there that Kevin mentioned. They're around the $21. Right.
Okay, Kevin, I do want to get your price outlook. I just want to ask you very quick. You are short-term bearish on Bitcoin. You foresee it potentially going down to $20,000. If that's the case, do you think then by extension you would be bullish on gold, or are they not really directly related like that?
Capital flows are important here. There's no doubt a lot of money invested in the crypto sector, and I think if working on the assumption that the breakdown in crypto total market cap continues without a fairly quick recovery in the near future, then some of that capital will eventually, no doubt, find its way into the precious metals, and we all know the precious metal sector is pretty small by comparison with general equities, and that money from cryptos will have an effect. But to what extent, as Patrick mentioned earlier, the price history of cryptos and the ability to sort of backwards analyze those capital flows is very limited. So I suspect some of it will find its way into the crypto sector. The silver squeeze and all that kind of thing may well start to take hold again. But really, that's all hype. And what is more important is the long-term directional movement, which I think these macro trends are really starting to take hold now. We've got a shockwave that's starting to pass through the global economic system. Just how severe that'll be and how long that'll last and the precise effects are as yet unknown. But I'm pretty certain that gold and silver, from everything that we've analysed, will be the main beneficiaries of what's to come. And platinum as well. I should mention platinum palladium and the uranium sector. Very bullish on all of those, but base metals may well suffer to some extent if the global economy slows down.
Mm-hmm.
I suspect gold, talking about targets, may well move into that 1800 area before accelerating rapidly beyond the previous all-time highs, probably somewhere into the mid 2000s of dollars, 2,400 to perhaps close to 3,000 in the next 18 months. We've got to remember the 8-year cycle low for precious metals comes in 2024. Silver targets, we could see somewhere down to the $18 area before a rapid move up to new all-time highs. So short term with both of them, we've got some difficulty to work through. But as soon as we get the technical confirmation that they're breaking out, that's the time to really pile in and take your last chance in this sector.
Right. Well, both of your timings have been pretty good so far. If viewers want to go back and watch our previous interviews together, your track records for your timings have been very good. So we'll take a look at what happens in this cycle. Patrick Karim and Kevin Wadsworth, thank you again. You're excellent analysts from Northstar and Badcharts. Thank you for coming on the show.
Thank you, David.
Cheers, David. Good to talk to you.
And thank you for watching Kitco News. We'll have more for you. Stay tuned.